Gary Wagner from thegoldforecast.com is back to offer up his take on just what's going on with gold and silver. This and more on this week's episode of Metal Money. I'm your host, Patrick Vieira. Gary Wagner from thegoldforecast.com. Welcome back to Metal Money. How are you doing?
I'm doing very well, and yourself today?
I'm doing great. Thanks for asking. Gary, last time we spoke back on January 12th, earlier this year being 2022, you had firmly stated to hold gold, hold silver. There are too many ifs in the market right now. And with the Fed recently announcing its biggest rate hike since 2000, with half a percentage point increase, has the number of ifs in the market decreased or increased?
In some ways, they have absolutely increased. We've watched gold and silver decline pretty much on a consistent basis over the last 4 weeks, especially if you look at a weekly chart. It started by the lead up with the expectation that the hike coming up, which of course occurred earlier this month, would be a 0.5%, and it might be followed by another 0.5%. But it was a couple of things that came out during the statement, as well as Chairman Powell's interview at the conclusion of the FOMC meeting, which didn't raise more ifs, but more wonderment as to whether or not the Federal Reserve can actually have a handle in curtailing inflation. One of the wild cards was they pretty much assured the public that there would be a series of 0.5% rate hikes when Powell said, we haven't disregarded, we haven't taken 0.5% rate hikes out of the picture for the last or for the next couple of FOMC meetings. And the word couple, of course, indicated that they're probably going to raise interest rates a full percentage, half in June and half in the July FOMC meeting. That really started the financial markets tumbling. Of course, we've witnessed consecutive declines in the S&P here, the Dow Jones Industrial, the NASDAQ, and the fact that we had follow through again today, that surprised me. I thought maybe we would see the market go into a oversold scenario and we'd even have a dead cat bounce, so to speak, or some kind of base forming, and that didn't happen. We had dramatic declines, about 3% plus with the NASDAQ. I think the NASDAQ composite declined about 4%. We had the cryptocurrencies crashing hard. Bitcoin was down about 12%. So if you put gold's performance today relative to 3% declines minimum in equities, cryptocurrencies absolutely getting devastated. And then you look at the fact that gold declined by 1.5%, that almost seems tepid compared to the other financial markets. Of course, yields have been rising on U.S. debt, treasuries, and bonds. The dollar has gone to a high that we haven't seen in, I believe, in about a year, 2 years since the first part of 2020. So that's the series of ifs that have increased. In a way, they've been answered. But the big if is whether or not these moves will curtail spiraling inflation. CPI for March came out at 8.5%, and the forecast for Wednesday's CPI for last month are mixed. You had an article in Forbes saying it would come in between 8.1 and 8.5, which would show it's either stabilized at 8.5 or diminished slightly. And then Bloomberg quoted a New York Fed survey in which they think it's going to be hotter than 8.5. So you don't have a unanimous forecast amongst economists and amongst the individuals that various news sources have been following and quoting. And so it leaves a lot of uncertainty as to what that number will be. I think it could be 8.4. But it could also be 8.6. I don't see it varying that much from the 8.5 we saw last month. And the rationale that I have is the primary causes of inflation, which are right now supply chain issues, that are really keeping goods in demand and not being able to fulfill those orders, and also the uptick in the COVID-19 cases in China, in which they have been really shutting cities down or parts of these cities down, and that, of course, is going to continue to pressure inflation and the war in Ukraine. So those are all things that the Federal Reserve has absolutely no control over. They can contract the US economy, but they can't address supply chain issues. They can't address the war in Ukraine, nor what's going on in China, whether or not shipments are coming out on time, or that creates a greater bottleneck. And that's where the additional uncertainty comes in.
Hey, absolutely great points. The Fed can't control the supply side of what's happening with the inflation there. But has the Fed's latest rate hike changed the case to hold precious metals?
It has, in a roundabout way, because what Fed action has done has been affecting the yields of US debt instruments. And when yields go up, that really strengthens the dollar. And it also makes gold and silver as an inflationary hedge less attractive because it doesn't yield any kind of interest payments on it.
Now, Gary, gold revisited its record high in March due to the Russia Ukraine war breaking out. Speculating a bit here, but closed the month under 2000. It has since gone under 1900. How do you see gold's path from here on out, technically?
I can I'll discuss different levels we're looking at, but I think the answer to that question, excuse me, will only be answered once we have the most current CPI inflation data out. Because if the data comes in hot or higher than 8.5%, on one hand, higher levels of inflation are very bullish for the precious metals, specifically gold more than silver. Silver can be under more pressure because of the industrial applications, but we've had this double-edged sword. As inflationary pressures grew, the idea that the Fed would get more aggressive also grew. And so Fed measures by raising rates is extremely bearish in terms of the force it puts on the precious metals. And the reciprocal inflationary pressures can have extremely bullish undertones. So it's, excuse me, well, so it's a combination of that push and pull that really creates the uncertainty. I'm not even going to venture to guess if it will find support. We have the first level of support at about 1850. I believe currently gold is trading about 1853. 1836 is the 200-day moving average, and I think that that is the most important and critical technical level that must be held if we want to say that gold on a very long-term basis is still in a correction, but a bullish pullback. In other words, we're getting this downside of pricing within a bullish market. That is normal. But if it breaks below 200 and continues down below that, that really changes the technical outlook for where gold and to a great degree, silver are headed through the rest of this year.
Yeah, that's 200-day moving average. Absolutely important there. With silver, it also had a similar rally above 26 as a result, again, of the war, possibly, but was unable to close above 25 on a monthly basis. It's once again reached that 22 level, even sub 22 level. So lower highs and multiple touches on that 22 level with silver. From your experience, though, Gary, what is the technical picture telling us about the probability of where silver is headed in the short term as well?
On a technical basis, there is a case to be made for a base or support at 22, 2190 that's fairly strong. However, especially with silver, which has such a large industrial component to it, if we continue to see pressure in US equities and a contracting economy, that will add additional pressure to silver that we typically would not see in gold, because gold is really looked at as a safe haven asset more than silver and a hedge of inflation, where silver has a small component of that, but a major component of an industrial precious metal. And so you've got those two factors that we have to look at closely. US equities are down. The S&P is down 13% from the highs 6 weeks ago. That's quite a drop. And the Federal Reserve is actively trying to contract the economy. That's the effect you're going to get when you raise rates. So if we get an economic contraction, that could affect silver with a larger percentage drawdown than gold.
So I got to ask this question. Are gold and silver still in a bull market where the two metals just for gold, it can't seem to hold 1950, much less 2000. Silver seems to have a hard time holding the mid 25 level. Are they still in a bull market?
Well, again, there's two ways I look at that. First, on a technical basis, if prices are above a 200-day moving average, a market technician is going to say that long term they're still in an uptrend. The other thing that I really think is important is we look at gold, let's say, going to 1900 or the recent move to 2003 and failure to hold that, and then moving below 1900 as an extremely bearish move. But when we look at the price of $1,850 silver in comparison to where it was when it hit the apex at 2088, it's still a very, very high priced metal compared to what it was 10 years ago when it was running from 700 up to 1900. Remember, the old high was 1920 in the middle of 2011. Granted, it was over 10 years ago, but prior to that, gold was never, we thought $1,200 was a really good high in gold, or 14, and then it went to 16, and then to 18. And I think we've taken for granted the tremendous move it made 10 years ago, and the fact that we had a multi-year correction, which took gold down to about 15 or 1600. Relative to that, because the way I look at a long-term gold chart is after it hit 1920, we had a multi-year correction, which had gold touch briefly to, I believe, 1040. And then it's been moving up since then. So as long as we're staying above 1800, around 1900, relatively speaking, gold is still holding up pretty strong. Will it stay there is the question.
Yeah, absolutely. That is the question a lot of people have here. Why do we see inflation though in the real economy with prices of goods some 20 to 50% higher, but precious metals not keeping pace to protect purchasing power? I mean, is this a knock on gold and silver being inflation safe haven assets?
I always look at gold as an inflation hedge that doesn't react in a very quick or meaningful way. In other words, if interest gets hot over a 3-month period and stays there, we're going to see gold play catch up over the year. It's not going to happen very quickly. And the other thing is that if inflation remains persistent, which I believe it will through the rest of this year at least, and the Federal Reserve keeps raising rates, the raising of rates causes some tremendous downside price pressure on both gold and silver. But if it is deemed ineffective in actually curtailing interest rates from getting hotter and resulting in inflation staying high and not really peaking, gold and silver will catch up to that at some point. But it's never going to be a 100% correlation month by month. It tends to happen over a protracted period of time. And we've seen that year after year, but it typically takes a good amount of time, at least 3 to 6 months, before gold will act as an inflation hedge and catch up to any real moves in inflation, because it's going to react to the average over a 6-month period or a 1-year period, and not the month to month oscillation or noise. in the level of inflation or the level of interest rates.
Okay, great points there. So I guess all in all, still continue to hold your gold, still continue to hold your silver.
As if you're buying physical and holding it, yes. In terms of trading, we put on a trade about 2 weeks ago. We went long at it moved so quickly, $1,933. It went up a bit. We raised our stop to 1938. We got stopped out on the Monday, last Monday, when forces took gold down like $50 in that day. And we have remained neutral with no trades in the mix at all last week. And to our premium subscribers, which is where I issue our trade alerts, I told them that until the CPI data comes out, I am not comfortable putting on any kind of trade, be it long or short, until we get more data and see where inflation is gone. And even if we look at forecasts, they're mixed. So we're not getting a good sense of what that read is going to be. And that to me is too much uncertainty to trade gold or silver. This might be a time to add to physical positions rather than thinking of liquidating them. It might be a time to be neutral. In terms of trading, we're neutral. In terms of physical inventory that your clients or our clients and subscribers might have, I don't see a reason to look to liquidate them, because at least when I recommend acquiring more physical silver or physical gold, I'm looking at a timeline of 3 to 5 years minimum. It's a long-term play. And so there's no reason to have $22 silver or gold at 1850 shake anyone out of the market. What you do want to be aware of is there is going to be a point in which it does hit some sort of a bottom. And when that occurs, that's the time to consider adding to your position.
All right, great point. So the big if of the CPI, a lot's going to be riding on it come this week and in the short term ahead. Gary Wagner from thegoldforecast.com. We appreciate the time you've given, and I hope we can do this again soon, and let's see what happens with that CPI.
Absolutely. It's going to be an interesting week, and thanks so much for having me once again.
That was Gary Wagner from thegoldforecast.com offering up his views on the ifs with gold and silver. As always, please leave your thoughts in the comment section below, and remember to keep it liquid, keep it real. And I'll see you on the next episode of Metal Money.